Hello, everybody, and good morning. Thanks so much for joining us on Retirement Solutions, the podcast. Tyson, man, we've got a great show today. We're just sitting here. The time we're recording this podcast, it is September of 2024. Of course, we've got an election year that's coming up. We just had the Federal Reserve drop interest rates by 50 basis points or 0.5%. You know, you've got these wild swings that are happening right now in a lot of different markets. As you pull up the Wall Street Journal, you see things like consumer credit cards are starting to become more and more delinquent. You're seeing default rates on mortgages start to creep back up again. You're seeing, families that are, because of inflation, they're starting to throw things on the credit card. In other words, income is not matching what expenses are. And
what you're really saying is we're seeing some cracks in the foundation, right?
Yes, we are seeing some cracks in the foundation. And, we've been around long enough that you have to learn when you start seeing cracks, you need to do something about it. So we thought it was time to have a show on risk. And that risk, of course, is one of the principles of the B.O.S. Retirement Blueprint. And, it's one of those topics that people always think that they're covering all of their risks, but we hear differently when you sit down in our conference rooms at B.O.S. Retirement Solutions and Advisors. You always hear these stories about, this one time I lost. The backyard barbecue, you hear, here was my winner. In the conference room, you hear about, here was the time that I lost money. Yes. And it usually involves tears or regret, and I wish I could push this back.
So in other words, they're telling their friends the success stories, but now when they're talking to their advisor, or their potential advisor, they want to disclose everything so they don't have the same problem again, right?
You got it.
So go ahead with the question, Ryan. I love this question.
This is one of our favorite questions. This comes from Keith Cunningham. We lead a mastermind with him every year for the last 2 years, and he is he's in the Business Mastery series for Tony Robbins. Just an incredibly smart guy from the state of Texas. He asked this question: if you could unwind the top 3 financial mistakes that you've made in your life, how much more money would you have today? Right? So think about that. If you could unwind the top 3 financial mistakes that you've made, how much more money would you have in your pocket? So let's open this up, Tyson. Let's talk about risk.
Well, I think first off, everybody would say I'd have at least a little bit more, but most people would say, man, I've made some mistakes that I wish I could have as mulligans, right? And
yes.
And we'll even talk about a few of our mistakes over the years, because those mistakes have made us better advisors. It's helped us to really dial in the B.O.S. Retirement Blueprint, which we'll get to in a little bit. But there's a few things that we've learned that we want to pass on to you today as wisdom, whether you come and see us or not, that you can think about. So there's a couple of investments as we were getting ready for today's show. If there's 3 different investments, we'll talk about maybe 2 of them today that we can say that we would have taken back. And so one of the principles, just to lay the foundation for all this, is there's all different kinds of investments out there, right? There's venture capital, there's penny stocks that would be all considered high risk. Even private equity, some people invest in, would be high risk. You really shouldn't have more than about 1% of your portfolio that includes something like that. You've also got then more stable things like annuities or life insurance that could really create some stable income streams. There's private businesses that you could invest in that would go into the higher risk category again. Or there's dividend paying stocks, or a really truly diversified stock portfolio that are going to be on the lower end of risk. And one of the things that when somebody comes in and sees us, very first thing we do is we measure their risk.
If you're talking about measuring the risk, just to get this scale, if we were to look at venture capital,
yes,
that would be a risk score of 100, right?
Yep.
That highest risk, or a penny stock, very, very risky, compared to an annuity that has a risk score of a 1. I mean, it's a 150-year-old company that's been doing this. It's not their first rodeo. They've been through all kinds of different recessions, depressions, and so that's kind of your skill.
And then stock can be, depending on where you have it, it can be anywhere from, say a 5 to and 100 again, depending on how risky it is. But usually it's going to be somewhere between a 5 and a 75 maybe.
And the deal we're going to talk about, this is a risk score of 100, right? So this is one of those ones that you'd want to have 1% or less of your portfolio in.
Exactly. So this was brought to us by a business group that they said, hey, look, the White House has just come out and endorsed this particular company. We won't worry about who the company is, but they are going to create charging stations for automobiles, for electric vehicles. That the White House has this whole thing that they want to focus on helping charging stations rolled out across the country. And they just did a press release on this company, and it's a can't miss. Usually this is a high risk thing, but it's a can't miss. That's what the story always is, right?
Risk score of 100 that you can't miss.
But this one's different. It's not really 100, even though you have to say it's 100.
Yes.
And so Ryan and I, usually in situations like this, we don't put up very much money. In this case, we put up $50,000, which was a lot less than 1%, falls within that category of high risk, but we're not putting very much money into it. And Ryan, after we put money into it, we kept hearing great things. People were talking about how the White House was continuing to endorse this. They were talking about how they were raising a lot of capital from a lot of well-known individuals from around the country, that if we told you their names, that they would be popular investors. And what ended up happening?
Well, summer of 2024, we got an email that said, sorry, guys, bad news. We can't continue this. The costs have exceeded revenue and projections. And because of the current environment, things have slowed down, and your investment is now zero. So in other words, they wiped out all of the equity investors as part of that move. And, that doesn't feel very good, Tyson. That's, to take $50,000 and turn it into zero. Ouch. Doesn't feel very good at all. And I think, a mistake that a lot of people make when they think about risk is they hear opportunities like that and they go all in, right? Instead of 50,000, it's half of their portfolio at $500,000, and they're thinking, oh, if this thing works, because I think that's a principle there. There's the principle of there's two very powerful emotions: fear and greed. This falls on the greed side.
It totally does.
Hey, I can take a $50,000 investment and I can get a 10x return on it.
So that's principle number one, is don't listen to the greed.
Yes.
Principle number two is don't take a lot of your portfolio and put it into there. Don't do 50% like you just talked about. Do less than 1%. And then number three principle in this is, no matter how sure of a good deal this is, White House it had endorsed it, and so everybody was saying, well, if the White House is involved, they're not going to let this fail. Well, they did, and other investors, well, these investors are invested in it, so there's no way that you can lose. Those are the three principles. Don't put in more than 1% in a venture or a high risk for 100% risk part of your portfolio. Don't listen to the other voices talking about it. And number three, don't give into the greed and put an outsized portion of it in as well. So
I'm going to put number 4. If the White House promotes it, don't invest in it
at all.
Because that may not feel very good. They don't seem to have a very good track record when it comes to investments. You think of Solera, you think of this one that we just invested in. Ouch.
Yep.
Now, want to be clear, as we're going through this, we are licensed investment advisor representatives. Everything that we're talking about here, this is all on our personal level. We do not invest in projects like this for our clients. Okay, these are outside personal investments. We thought that it was important to share these because I think oftentimes you learn more from mistakes than you learn from the wins, right? When you have the wins, it feels good. The wins at your back, everyone's cheering. That's the one that everyone talks about at the backyard barbecue. These are deals that no one wants to talk about because 50 going to 0 doesn't feel very good. But let's talk about deal number 2, because deal number 2 is a little bit different. Okay. We have a very disciplined, if you think about the B.O.S. Retirement Blueprint, there's 5 buckets on the B.O.S. Retirement Blueprint. There's the cash bucket, just how much should you have in liquid funds for emergencies. There's the income bucket. This is where do you generate income when your paycheck stops? And income, you can retire successfully when you have enough reliable income that pays for your lifestyle. That's it. Retirement's no more complicated than that. And then we have your growth bucket, which is the risk bucket that we're talking about today. And then you have your tax bucket, and then you have your legacy bucket. Now, this next loss that we're going to talk to you about, number 1 is it's not quite fully a loss yet, but in our minds, Tyson, we've chalked it up already to a 0. But this one, when we were looking at it, the investment was something very simple to understand. It was an ATM fund. Okay, so this is an ATM fund. And again, this is not something that our clients invest in. This is our outside personal investments, but it's an ATM fund. So, if you go into a gas station or you go to a football game and you need some cash, there's ATMs there. This particular fund would purchase and then also place the ATMs, and then they would manage it. And then you literally got mailbox money when it came. So what we liked about it is it paid monthly. It paid the distributions monthly. So
it had cash flow.
That was the first principle. And then also bucket number 4, there was a tax benefit to this because it was real property. It was able to use depreciation principles, which was able to offset income. So for example, for every dollar that you put in, you're going to be able to offset the purchase. So each one of these purchases were just around 100,000. And Tyson, we bought 4 of them. Okay.
Yeah.
So we bought 4 and we bought 2 each. So that was $200,000 each. And it really checked every box that we had.
We did our due diligence. There was a lot of good information out there that we could go and research. And
yes.
It felt like a really safe investment, like putting money in that income bucket with the blueprint.
Yeah. And there was an operator. This wasn't their first rodeo. They were well-established operator, had been in the industry for a very long time. We're one of the top 5 largest operators in the United States. So it absolutely made sense.
They also had somebody who was auditing the financials and, so all of the boxes that we need to check as advisors were things that we could have as transparency. And, that's another learning here is you need to see as much as transparent as possible. So we knew something was up when all of a sudden we stopped getting our monthly checks. And it started by saying, hey, look, the accounting method we're using, the auditors have suggested that we go from a monthly payout to a quarterly payout, which really didn't raise that high of a red flag, only because there's a lot of, in the financial industry, there's a lot of investments that only pay out quarterly. But then that next quarterly payment came due and it didn't get paid. And so then we knew that there was something going on. So we're in the middle of this. We'll see what happens with it. But even the things that seem like they're transparent, you can do the research, there's cash flow, there's great operators, even some of those things can go south. And this even goes back to our opening comment about we're starting to see cracks in the foundation here in September of 2024 that maybe a lot of people don't see yet. And it's one of the reasons why we want to talk about this today is because we usually see from a business perspective with what we do in our industry, these cracks in the foundation faster than a lot of folks do who don't do this for a living. And, we've talked to a lot of business owners who their cash flow is starting to change the way their business runs. So there's a lot of concern that we're seeing that you need to ensure that you have a buttoned up plan, that you're not doing, this is not a do-it-yourself project. And so, Ryan, let's shift to the three learnings that we really want people to take home to today. And the first one is one of the things that we always tell our clients is, because we have so much experience, and even some things that we don't allow our clients to invest in because they are too high risk for, we're still a ways away from retiring, that we would never let one of our people who are 5 years or less away from retirement to even invest in. Learn from your past mistakes. And any mistakes that we have ever made actually make us a better advisor, right? So that's number one thing, is our past mistakes make us better advisors because we understand what the risks look like, and we can guide you through that so that you don't have to make the same mistake. That's what this really boils down to, is you don't have to make the same mistakes that thousands upon thousands of other people who are trying to do this yourself may have made, so that you can avoid that pitfall of making those same mistakes. What's number two, Ryan?
Well, Tyson, let me just say one little note on that, and then I'll go to number two. It's also, we're sharing these things today. We're being vulnerable on some things that didn't go well for us. These were all outside investments. These are personal investments. But, the economy sometimes can work against you. And these cracks in the foundation that we've identified with inflation, with rising interest rates, with deals when money was easy, right? When money was easy as interest rates were super low, you saw all these alternative investments like buying businesses, looking at multifamily housing projects. And a lot of these deals were put together with very cheap financing to go do it up front, and then bridge financing on the back end, which now is like 2 to 3 year fixed bridge financing, which is now expiring. And now those companies are trying to scramble to get the financing put in place. And then the investors were the third piece. We're being open and honest with these because we know that a lot of different individuals during this same time period have invested in projects like this. It's okay. Right? Hopefully you didn't put your more than what you could afford. For Tyson and I, these projects that we invested in, these were a very small part of our own personal portfolios. And, they zing, they hurt. They don't feel good. And so when you learn from that experience, you're wiser. Okay. You're absolutely wiser. Here's the second principle that you need to understand is, in anything, it's important to be well diversified in your plan. And when we talk about having a plan, our plan is the B.O.S. Retirement Blueprint. B.O.S. stands for Build the Optimal System of Security. When it comes to income, you want it to be reliable and know where that money's coming from. It starts with Social Security. Okay, this is having a plan over some particular product or investment. Knowing where your income is going to come from. We recommend that you have 3 streams of income: income for today, income for inflation, income for your rising medical costs as you go through retirement.
Yes.
When we say reliable, this is not the type of deal that you put in outside investments that could go to zero, or something could happen. These are things we like. Annuities. I mean, we absolutely love annuities. And the reason why, you're putting your money with an insurance company that's been doing this for 150 years, 175 years. They've been doing it for a long time. It's not their first rodeo. And then the other thing is, you're putting your investments, your serious money, into places that cannot lose principal value. So even if something goes wrong, you're not going to lose value. For example, if you're invested in an S&P 500 product that's linked to the performance of the S&P 500, if the S&P 500 goes down, you don't lose any money. If it goes up, you participate in those gains, and those gains are then locked in. That market index strategy is different from index funds. A lot of times people think, I'm in an S&P 500 index. Well, you can go get that at Vanguard or somewhere like that, very low cost, but you're just going to ride up and down with the market. Market indexing is very different, where you protect principal in times that are bad and you lock in the gains. I think we're going to see more and more people that are going to want to go to that safety when the cracks in the foundation here moving forward become fully exposed to what's happening. And then the third piece, cash value life insurance. We love cash value life insurance for the tax diversification. We love Roth for the tax diversification, where your gains are tax-free distributes out tax-free. Some of those things in the strategies there, those are part of the strategy of your blueprint. So remember, plan over product or plan over certain investments. And Tyson, what's number 3 that we want you to take out of this today?
We want your investments to be boring so that you can have an exciting retirement. That's what this is all about. So as you get closer to retirement, Ryan, you mentioned plan over product with the B.O.S. Retirement Blueprint. We've helped literally thousands upon thousands of people to retire successfully today. And one of the fun things is hearing the stories. We just opened up a 7th office in the state of Utah, and we had an open house, and one of our clients came through, and he was telling us, he and his wife were telling us about why they came to B.O.S, which was they loved the safety and security that we talk about, but they told us basically, look, every time we come in, our advisor tells us everything's great, you don't have to worry about things, so that we can go out and we can actually do the things that we love to do. That's one of the most fun things that we get to do, is hear how you want to move the needle in your retirement. Everybody's got something that they want to shift from. You spent 20, 30, even 40 years doing something at work, and now it's time to be able to really enjoy the next phase, whether it's traveling. For this couple, they talked about how they bought some land and an RV, and they have this beautiful piece of ground that they go to, and that they just come back from there, and they had just spent a couple of weeks there, and they had their grandkids that they brought out with them, and he was able to teach them some principles, not only from the B.O.S. Retirement Blueprint, but they were able to just go and enjoy those kids as their grandkids and really make memories together. That's what retiring is all about. You do not want to be tied to the stock market every day, where, I had another client who came in, and we created their B.O.S. Retirement Blueprint for him. And he said, this is the first time that I recall not having to worry about waking up, and the very first thing that I do is that I open up my computer and I look to see how the stock market's doing. I don't really care anymore how the stock market's doing, because I know I've got a plan in place that's going to get me to and through retirement.
Yeah. Tyson, I think as we wrap up here, I think one last principle that we want to cover is, what if you don't know how much risk you're taking? I mean, a lot of you that are listening to this is not what you do every day. You don't think about your money every day. You're working, you're in retirement, you're spending time with kids and grandkids, and you don't want to, spend all this time thinking about the dollars. That's why you have hired B.O.S. Retirement Solutions and advisors to help you with this. One thing I would, for those of you who are wondering, how do I measure your risk? There's really awesome tools today that are available. One thing that we run is what we call the B.O.S. Retirement Risk Report, which we take your stocks, your bonds, your mutual funds, whatever you have as far as investments, and we can measure the risk. Here's why this is powerful, is because we actually come up with a speed limit sign that helps you understand how much risk you're taking from 0 to 100. And it's really eye-opening for a lot of people, because when you run this analysis, what you see clearly, how much am I risking with my dollars? I mean, we see a lot of them that are like, the risk score comes out at an 85, And so if you're 80 to 90, right in the middle at 95, think about this like if you're driving down the freeway and you have a car accident, right? If you have a car accident at 85 miles an hour on the freeway, number one, you're going way too fast. You're exceeding the speed limit, but that accident is going to be terrible. So what should you do? If you're not okay with losing that much money, fix it. Just adjust your risk. And, Tyson, this is what we love. It becomes awareness first. That's why we're talking about this question. Right. How much, if you could unwind the top 3 financial mistakes that you've ever made in your life, how much more money would you have today? Whether that was a divorce, whether that was a bad investment, whatever it was, think about how much more money you would have today. And we want you to take from this podcast, we want you to take your experience and turn it into wisdom. The combination there is when you take action and you learn from the past so that you can move forward with a new vision and being able to accomplish the things that you want to do. So, Tyson, any last words that you want to say on there about risk and making sure you don't have losses?
Well, this has been a great show today because we've talked about this risk profile. The last thing I'd say is just make sure you have at least 3 different income streams. That becomes a really important piece. So, to summarize and to wrap up today's show, really, all of this is encompassed in the B.O.S. retirement blueprint. Whether we're talking about the cash bucket and then setting aside enough money, whether we're talking about the income bucket and making sure that you've got at least 3 different income streams throughout your retirement life, whether it's measuring that risk in the risk bucket and making sure that you've got a truly well-diversified portfolio, whether it's trying to save money on taxes and helping you to keep more of that hard-earned money that you have set aside for so many years instead of passing it on to the government. Or lastly, how do you make sure that you keep more of that for those you love from a legacy? All of that is encompassed in the B.O.S. retirement blueprint. B.O.S. stands for Build the Optimal System of Security. And if any of this resonated with you today, first off, like this podcast and leave a 5-star review if that's what you feel like you can do, to let other people know about the algorithm that gets us our message further out there. But secondly, just click on the link below and we'd be happy to help you to get your own B.O.S. retirement blueprint, because here's the great thing. Retiring successfully today, it doesn't happen by accident. It starts with a plan, and that plan truly is the B.O.S. retirement blueprint. We'll talk to everybody again soon. Have a great week, everybody.
Thanks for listening to the Retirement Solutions Podcast with Tyson Thacker and Ryan Thacker. If today's episode inspired you to plan for retirement, go to bossretirement.com/podcast to receive a complimentary B.O.S. Retirement Blueprint. We'll be back in 2 weeks with another story to help you retire with confidence. B.O.S. Retirement Solutions is an independent financial services firm helping individuals create retirement strategies using a variety of investment and insurance products to custom suit their needs and objectives. Investment advisory services are offered by duly registered individuals through B.O.S. Retirement Advisors, B.O.S., an SEC-registered investment advisory firm. The information contained in this podcast is given for informational purposes only, and no statement contained herein shall constitute tax, legal, or investment advice. The information is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. You should seek advice on legal and tax questions from an independent attorney or tax advisor. Our firm is not affiliated with the U.S. government or any governmental agency.